All right. We are live. Monday's Q&A. Matt, the mortgage guy here. I've got a special guest this week. I think folks are excited for me to have an underwriter on, Brett Degracia from United Wholesale Mortgage, a senior team lead underwriter. Thanks for joining this week, Brett.
Awesome. Thanks for having me.
Yeah, for sure. I think folks are going to have some questions for you, and hopefully we don't overwhelm you. But being a senior team lead, you know your stuff, and week in and week out, I'm trying my best to answer some of these underwriting questions as a loan originator. But some of them they get really into the weeds, and I'm like, man, this is a great question. I don't know the answer to it. So looking forward to getting into it. Tell us a little bit maybe about your background, your role, and then I'll start firing off some questions I have that came in before the show here.
Awesome. Yeah, I was a loan originator for about a year and a half prior to getting into underwriting, and then got in at the United Wholesale Mortgage here in Michigan and spent a few months as an underwriter too. So that's primarily looking at your title work, appraisal, assets, and then as a senior underwriter is when you're going to review your income. But then been a senior team lead for about a year and a half now. So dealing with escalations, different scenarios, underwriting the file from start to finish.
Okay, so you get to see the most intricate of files then as a team lead as it gets escalated to you.
You get the good escalations up here, yeah.
Right, yeah. It's not like the clean and easy files. As a loan originator, yeah, it's like, oh, you've got W-2 income and you've got an 800 credit score and no derogatory stuff, and it's a piece of cake and it flies right through. Yeah, if only all files were like that. Unfortunately, they're not, and so you get to see some of those. While we're waiting for folks to jump on, tell me maybe, we don't have to share anybody's personal information, but what kind of stuff do you see that maybe, through the first levels of underwriting is something where they're like, hey, we need to escalate this. We don't know how to figure this out. What sort of scenarios come to mind when you're thinking about that?
Great question. Yeah, lately, with the way 2020 was with COVID and decreased workforce, now as the economy is ramped back up, if you have a borrower who maybe gets a bonus every year, maybe is based off of commission, we really need to analyze that income, even though 2021 is now probably hopefully back to normal, but we do look at the lower of 2020 and have to take that into consideration as well. So that's something that keeps coming up with different types of income.
Right.
Nurses are often variable, and things like that really come up. And sometimes you look at, now I'm making a lot of money, but depending on the type of work you're in, we have to look back at 2020 and 2019 and average out that income to make sure that we're looking at the stability overall.
Right. Yeah. And I think that's where some people, I explain it to them and I'll tell you how I kind of understand it. And then you can, correct me if I'm wrong or maybe, educate folks on, as much as I might look at a scenario and say, okay, that makes sense. You were off for 3 months or your pay was decreased because of this event. And now you're back to full-time, full pay. As much as me and Brett would like to say, oh yeah, we see how you make $7,000 a month now. Unfortunately, like guidelines dictate how much income we're able to give a borrower. And if the guidelines say your variable pay and we've got to take an average, there's no magic wand, right? Like you don't have any special passes for the extra nice people or the exception pass for somebody to say, we're not going to take the average on this client because they're nice and they've got an 800 credit score. So we'll just take $8,000 a month.
Correct. And then often I had an escalation earlier where the borrower was a base pay through 2020. And then around September, they went to strictly commission, still with the same employer. So it's the way that we have to look at it and analyze it. Luckily, with some variable pays, you can have a minimum of 12 months history and still be okay to proceed. But it takes some fine tuning and really looking at the history overall.
That's interesting to know. So what type of borrower would qualify there? where, their pay has been variable since, let's call it October last year. So it's been at least 12 months and they've had some variable pay in there. What was the prior history that might make that deal work?
If there's other types of income that we're not using, maybe they get a lot of overtime, but we don't need it, we can consider that a positive factor. If we have an increasing trend, if they had just started the job and went through training, say more of 2020, but then we get into 2021 and you can see that increase. We can look at the stability there. We're still going to average over the lower of the previous, but with those positive factors really helps the file overall.
Okay, cool. Yeah, I had a question I wanted to ask you before I start jumping into some questions that I'm starting to see pop up. And maybe you can give us kind of a student loans 101. Somebody asked about, how are student loans calculated? And I know that, there's Fannie Mae guidelines and there's Freddie Mac. And I know that your specialty is in conventional. So we can just talk conventional here. What are the different calculations that we're going to use on a conventional loan for student loans? Because, some people are deferred. Some people are in an income-based repayment plan. Some folks, haven't paid because of special, COVID rules for repayment. So maybe walk us through kind of an overview of that.
Oh, absolutely. That's the fun part about student loans. Over the last year and a half, they have all been in forbearance for the most part, in deferment. When you pull your credit, you're going to see that you have a $0 payment about 99.9% of the time. So when we see that, there are two different options with conventional. There's the Fannie Mae and then there's the Freddie Mac. Luckily, Fannie Mae will let us use 1% of the overall balance as the payment. And then Freddie Mac will allow us to use 0.5% of the overall balance as the payment. So depending on which one, you have to go, sometimes you might be refinancing and one of them gives you an appraisal waiver and the other one doesn't. So there's a lot of artwork that goes into it sometimes.
Right. Yeah. And so, for the audience, if what we're talking, kind of went over your head as far as, 1% and 0.5%, I like to third grade level a lot of this stuff. If on your credit report, you've got $45,000 in student loan debt, we're either going to use $450 a month, 1%, or $225 a month, 0.5%. And like Brett said, we've got two automated systems, Fannie Mae and Freddie Mac. And when we run that automated underwriting system, while we know we can use 1% over here and 0.5% over here, we're also going to look at this one needs an appraisal, this one doesn't, or this one, is asking for reserves and this one is not. And so, that's where having a, broker and a team that knows what the heck they're doing is going to, what I like to tell people is not necessarily I'm going to get you to the finish line and this other broker's not, but I might get you there a lot smoother path. I'm going to ask for less documents. And, anybody who's worked with a mortgage broker with a lot of experience knows that, like, I'm not going to ask for stuff we don't need. I'm going to structure the file. Team's going to structure the file. We're going to ask you for exactly what we need because Brett doesn't want more documents than we need. My team doesn't want to, have a document that was submitted that wasn't necessary that, in turn has us chasing down other conditions. So I'll stop beating that to death. I think the moral of the story is find a great mortgage broker and your life will be easier, whether you're buying or refinancing a house. So thanks for that, Brett. I'm gonna pop in here. We got Kevin Hawthorne who's joining every week and just saying hello. Hello to you, Kevin. Zita's another faithful follower. Zita, I keep telling everybody, you can't say you have a dumb question because inevitably there's 50 other people that are either going to watch it live or watch it in a replay. Be like, I had the same question as Zita. Zita was the only one brave enough to ask it. So I appreciate all the questions. The ones that are the simplest ones are the ones that most people have. So what does an underwriter do and how do they affect getting a loan? It's a great question, because I'm sure there's people that, don't understand and maybe they think they understand, but they don't know. So this is a great question, Brett, for you to take on, what does an underwriter do?
Absolutely. So basically, especially in Zeta's case, she's going to go and say, "Hey, Matt, I want to refinance." You're going to take her loan application and get her income. You're going to get her assets. You're going to look at the collateral. You're going to put together that loan app, and then you're going to send it over to me. And then we're going to look at the full credit history. We're going to look at the income. We're going to go ahead and calculate it, as well as analyze the collateral itself. Sometimes, like you said, we do get that property inspection waiver, but sometimes we have to get the appraisal. But then we're going to look to see what we can do to make this a fundable loan so that she can save money or get cash out and, hopefully fulfill her goals.
Right. Yeah. And this is something too that I know for me and for many others, there's plenty of memes on the internet about underwriters and them trying to, not approve loans and they're the big scary enemy. Underwriters are taking what we provide as the mortgage professional, trying to fit it into the guidelines and check off the proper boxes so this loan can be sold. And we're all on the same team. When Zeta contacts me as a mortgage broker, I want to see the loan get to the finish line. That's my job. Brett is on the same team where he also wants to get to the finish line. There's certain criteria that has to be met. He doesn't write the rules. I don't write the rules. But, whether it's going Fannie Mae or Freddie Mac or whatever, guidelines we're underwriting to, we just have to make sure. Okay, it's required that we have 2 months of assets. Check. It's required that we have 30 days of pay stubs. Check. It's required we have this. And so underwriters, mortgage brokers, same team. It's not like a big scary, gatekeeper who's guarding, the loan approval castle behind him and he's trying to not let anybody in. And so, yeah, I want to clarify that for some folks who think that underwriters are the enemy. You guys are nice folks, right, Brett?
We have fun. We do. We're not here to we're here to just verify what you told us, and hopefully it all pans out.
Right. Speaking of that, I don't know. This is kind of an off the wall question, but I had one. It probably was like 3 years ago now, where somebody provided me with fake pay stubs. I didn't know it. Underwriters caught it. Underwriters made me aware and said, "Listen, good thing this loan didn't fund because that's a ding on you and your mortgage license." But the big red flag for them was like, if you Google create a pay stub, this is the first fake one that comes up, and they use that template. What's the craziest thing you've seen as in your years as an underwriter, as far as people trying to, submit maybe some not so up and up documents?
We have seen that. We've definitely seen some forged pay stubs, but not even really. Sometimes not forged, but sometimes someone might work for a family member and they have history of working for that family member. But a month before taking the loan application, they're paid times by 10 right before, and they said they got the promotion.
Yeah.
Well, unfortunately, you don't have a history of earning that level of income, so we do need to look at that deeper when you know who you're working for, or if it's a close family member, and that's a whole nother level of risk that we look at.
Right. Yeah. So Johnny goes from making 2,500 a month to 25,000 a month, and that's not good if Johnny's dad is the owner of the company.
Yeah, that has happened. Luckily,
go ahead.
Luckily, in terms of the pay stubs, that's not really a big issue, because we do have verbal verification team that will call the employer. That is, use that number, that emails in a database where we will verify the employer itself, not strictly the name and number that's on that pay stub. So there's a lot more in-depth analysis now that goes into looking into income. The last thing we want is another 2008, 2009 issue. So luckily we look very deep into the income. We verify it.
Sweet. Good stuff. Shout out to my buddy Kyle, Win the House You Love. Most people know this guy. He's the GOAT. And when it comes to YouTube mortgage folks, he's got a great channel, great education and all that stuff. So you've even got fans in my chat, Kyle. Hello, Win the House You Love. don't leave just yet, but once the live is over, go check out Kyle's channel. He's got good stuff on there, and he's the goat that we're all chasing as far as YouTube mortgage educators. If that's whatever, if that's the niche I'm in, right? All right, Corey's got another question that's in relation to that last one we talked about, which we went down the path of falsifying documents. I don't know if that's the right path. I don't recommend that for anybody. And just as a warning to folks, I've had people who have, committed some sort of fraud, whether it's occupancy fraud or pay stub fraud or whatnot. You will essentially get placed on a list where no lender will ever lend to you ever again. So don't do anything in regards to fraud. Corey was saying it's easy to submit bogus leases and have friends deposit rent payments in your bank account and you repay them. I don't know. I don't know if you want to comment on that one about bogus leases, but
I'm sure they're possible. What we do when we review the assets is that when you see a deposit, it's one of the things you're going to look at to see if there's a withdrawal directly after that within a couple days. So that's another layer that we're going to look at.
Yeah, don't have that loan be looked at after the case there, Corey. You might get yourself in some trouble, buddy. I do not recommend it. All right, we got some questions for you. Flash a Light is asking, how do you deal with remote work hundreds of miles away from the principal residence? Getting an employer remote work letter committing to permanent remote work is not easy. Oh, and then the follow-up, I guess, is... the follow-up here was an employer isn't going to write a letter that says employment is guaranteed for a year or any particular time period after. So, yeah, somebody's working remote. The employer won't necessarily say what length of time. Maybe the employer doesn't know. How hard is it for somebody to get a loan in California when they, home base is Louisiana or something?
For sure, that's been coming up a lot, especially with the COVID and offices are going remote. Really, we look at the type of work that they do. If they're a warehouse worker, then they're not working remote. But we have a lot of IT professionals, a lot of engineers, even sales and training that are working remote. So it depends on the type of work that they're in to see if that's going to work. If it's a refinance, then and we have the pay stubs, we can usually reasonably say that is continuing. In terms of the letter of a guaranteed for a year or not, I don't think we really look at that. It's going to be your history of stability rather than moving forward. So we've never said, we've never conditioned for anyone to say that, give us a letter guaranteeing that you're going to be here in 6 months or a year. Since you work there now, we can usually assume it unless it's like a temp job.
Cool. Yeah. And like you said, if you're a, warehouse worker or something that requires manual labor, you can't work 1,000 miles away, but a lot of jobs nowadays with Zoom and whatnot, you can work in an admin role, you can work in a tech or something role. So cool. All right. Kyle, the GOAT from Win the House You Love, wants to know, how do you feel about AI technology in the underwriting process? Does the future look promising in using tech to make the mortgage process easier and stronger data?
Oh, Kyle. No, you can never take the human element. You never take the human element out of underwriting. You still need to use the logic. And sometimes we have to condition for something just based off of gut, not necessarily off of a guideline, but I need to make sure that this income is going to continue. But in terms of technology, there's always ways to review documents faster, to just have that in-depth, knowledge and review quicker, make sure that there's the clean loans, make sure that there are this is going deeper, but no repurchases, things like that on the secondary market is always something that as an underwriter we look at.
Right. Yeah. And I think it's like you said, it's like with most anything, like financial advisors, loan officers, underwriters, there's going to be a healthy mix of, technology and personal touch, where, UWM's leading the charge in a lot of things, especially technology. And so all this technology that's being created, and the newest one where you're, plugging in a bunch of stuff to get an initial underwrite done with technology, still going to be reviewed, still going to need guys like Brett in place where there's an escalation and whatnot. But I think, most large mortgage companies, from my view as a mortgage broker, are embracing technology to make the process easier, faster, and cheaper for consumers. That's just the natural progression, and that's what technology does to almost any industry, is allow us to scale and do it faster and easier. But Brett's not too worried about being replaced by a robot anytime soon, right, Brett?
Not anytime soon. The speed, even the speed 5 years ago, the average on a refinance was about 45 days. My brother just refinanced about 2 months ago, and he closed from application to closing in 8 days. So, the technology definitely helps, saves that money quicker. You don't have to worry about things that happen in process. And now the speed definitely helps with helped by the technology on that case.
Yeah, for sure. Yeah, I know you're not talking about replacing people, but yeah, tech to empower for sure. I mean, and Kyle's younger and smarter than I am, so he's more techie than I am on his Win the House You Love website, and on his YouTube channel. He's got cool tech tools for helping people find out the max they qualify for and all kinds of cool stuff. So yeah, I think the same when underwriting, and the same for Kyle, using tech to empower. I mean, that's a big part of what I do, is empower home buyers so that when they go out there and they're submitting offers and, going through the home buying process, they feel comfortable with it. And, even for a guy like me, an old timer who's 41, an Excel spreadsheet that's editable, that's high level technology for me, where somebody can say, oh, at 400, here's how much my payment is. And when I buy something for 450 with that same 10% down, here's what my payment is. That's it's not Kyle Seagraves type technology, but it's at least, with the same thought in mind, like you said, Kyle, to empower folks. Okay, here's a good one that's directed at Brett here. Why do underwriters ask to see the account used to pay off a recent debt?
Ooh, this is a good one. So it depends on when the debt was paid. If it was before application date, you typically just want an LOX, a letter of explanation, to say that you did not take out new debt. What happens is that sometimes a borrower is going to take a loan application, then they realize that they don't qualify with a certain debt, and they'll pay it off or pay it down. We just need to verify that you didn't take out new debt as well. So in terms of, I paid off this car loan, but maybe you took out another car loan. So we want to see that you paid off that $15,000 car. Did you do it with another loan, where we need to account for that? Or did you take it out of savings, and then we can see that $15,000 come out? Same with credit cards. Sometimes it's done just by happenstance, or sometimes it is to qualify. So we need to make sure that no new debt was obtained after the loan application was taken.
Awesome. That makes total sense. And that's the thing about underwriting that I think folks need to understand, is underwriters have questions and they want documents, but it's all for good reason. They're not trying to ask questions or hold up a loan or make it a longer or more tedious process than it has to be. It's just that, based on guidelines, it's like, hey, you've got a debt paid off. We've got to show there's no due debt, and where that money came from. All right, we got that. Good deal. And I think sometimes, at least with my experience with clients and being consumer facing, is like when people understand the why, okay, that makes sense, right? Because at first some people are like, man, they want to see this, or they want a letter on this, or they want that. Well, yeah. I mean, first off, they're lending you $400,000. If you were lending out $400,000 of your own dollars, you'd probably ask some questions too. And then they're, getting things in the file that they need to package it up, sell it on and meet guidelines. This is kind of a random one, Trent, but I can probably answer this. Were lenders taking applications on Veterans Day, all loan officers working? Speaking on behalf of some loan officers, a lot of us were using last Thursday, Veterans Day, to catch up on some work. Title companies were mostly closed. Lenders were closed, but as loan officers, it's a set your own schedule type of thing. And even though I told my team, only as needed work, I think most all of us were working on that day. Anybody who's in a season of growth or growing their business has got plenty of work to do. And sometimes when, the titles company's closed and you're not doing signings and there's other pieces of the process that are closed down, loan officers are catching up on work and contacting clients and doing whatever they need to do to get caught up. So this next one's for you, Brett. If an underwriter was a Marvel character, would they be a villain or a hero?
Oh, the underwriters that I work with, definitely heroes.
I second that, and like I said earlier, these same team, they're trying to save the day. I'll tell you what, people would be surprised about, I think a perspective some people have is that they're submitting a loan and the underwriters, gatekeeper trying to say, stay out, no, we need this, no, we need that, you can't proceed. And that more often than not, high level underwriters are saying, you know what, as structured, this thing's not going to go. If we pay off this debt and we use this, we can make this thing qualify. The desktop underwriting is going to approve this loan if we get this back end down to 43, or we, lower the front end by doing this, or, maybe we got to structure it with an extra 5% down, whatever the case may be. Underwriters are way more often than not the heroes, right? And like I said earlier, and I'll say it again, is like same team. An underwriter doesn't get, any high fives or bonus points from their team when they decline a file. And when they got to make a call to a broker and say, hey, I've got no choice here, I've got to decline this file, I just want to talk with you through it. That's another thing that people probably don't realize is that, a loan officer packages a deal, sends it off to United Wholesale Mortgage. If the underwriter can't figure out a way to restructure and make it work, or if there's no workarounds and they have to decline it, they're going to call the loan officer personally and say, hey, listen, on the, Jones file, I'm going to have to decline it. And here's why, income was declining, or, we can't use this part of the income, or there's this issue with it. But, that's something that, I can tell from, the voice of the underwriter I'm speaking to. And then, it's them knowing that I'm going to have to go back to a client and say, hey, we're going to try to make this refinance work, but based on, 2020 and how you were paid through COVID and whatnot, we can't do it right now. I don't know. I went off on a tangent there, but I'm basically defending my underwriter pals. All right, everybody, take Kyle's advice. Don't forget to like this video. And if you're looking to get a loan, reach out to Matt. You know what? This is good, Kyle. This is good advice. Let me plug this in real quick here. GreatMortgageBroker.com. I created that landing page so that if anybody's looking for a great mortgage broker, no matter where you're at in the country, you go there. 6 quick questions: where you're at, what you're looking to do. We will get you in touch, and somebody will reach out within, we say 24 hours, but it's quicker than that. We know you want help right away, so we'll be in touch very shortly. All right. That was my commercial. Now we're back to the action. Oh, that's a good question, Zita. Do underwriters work for the lending company, or are they independent?
All right. Yeah. Oh, no. Yeah. Underwriters work for a lending company. So they are, we are separate from Matt, the mortgage guy. We're going to be in a lender that's going to actually be the one giving out the money once the file is funded.
Right. Yeah. So any lender that I broker a loan to is going to have their own underwriting departments, their own underwriters, and their underwriting files. for United Wholesale Mortgage, Home Point, Caliber, EPM, whoever it is, they're working for that lender and underwriting files for them. And, you know, the big lenders, like the one that Brett works for at United Wholesale Mortgage, there's hundreds and hundreds. How many underwriters are there at UWM total?
We're around 3,000 total.
Holy guacamole. That's a lot of loans being underwritten. 240 billion or so this year, maybe. You have any idea what that number is going to be this year in 2021?
Ooh, in 21, I'm not sure where we're pacing. We just had the biggest quarter that we've ever had, though.
How big was it? 60 billion-ish?
I think it was.
Yeah, I don't remember. I know that number somehow got into my brain, so I don't know. I might have saw it somewhere, but I know that you guys are on pace for over 200 billion in loans. So you guys, what's that one saying? You know a thing or two because you've seen a thing or two. That's probably the case for, you know, an underwriter like Brett or a team lead. And I guess that's a separate question for you, you know, for you and your team, since you're a team lead, how many files are you underwriting in any given week?
Ooh, as a team, we are seeing just, you know, so kind of like your broker shop, along with U Mortgage, and Anthony is one of 5 broker shops that are assigned to my pod of 11 underwriters. So we are doing new underwrites, roughly just our pod, 20 a day. So 100 a week minimum, but we have almost 200 pods in the entire company. So the goal is about 4,000 submissions a day. So new loans that are coming in to be underwritten. So it is a lot.
Imagine. Yeah. I don't think people could really like comprehend million square feet of workspace, you know, in 2 different buildings, like I think they're about 1 million each one. Right. And yeah, 4,000 loans per day being underwritten, and like what you need human capital wise to, you know, actually underwrite that and move that stuff along. But yeah, if anybody can visualize that, it's a big thing. Oh, this is Will asking, have you met Matt Ishbia?
Yep, I've met Matt a few times. I think Denisa is probably on here too. She's on my pod. One day we showed up, we had a couple voicemails from Matt directly, just saying good job. So Matt's always walking around. You see him playing basketball in the we have a whole gym in the building with a full size basketball court. So he's always around and about.
Yeah, I think he does certain days. He goes around and kind of just pops in places. Yeah.
Oh yeah.
Tina's on here from my team, and she loves to look at new files. And so thinking about 4,000 files a day makes her head spin. I won't ever scale that big, Tina, so don't worry. I'm never going to be looking at 4,000 files a day. Maybe we'll cap ourselves at 3,000 a day, the Math and Mortgage Guy team. Oh, this is a good one. Corey said Brett must be very important because Matt never wears a suit and tie during live streams. I dressed up for Brett. He's a very big deal. This guy is highly regarded, respected, and adored at United Wholesale Mortgage, you know, as a underwriting team lead. And Kyle's asking, do you specialize in any certain types of loans? It's conventional, right?
Conventional, yep.
Yeah.
Fannie Mae, Freddie Mac.
Oh, there's Denisa. She's in your pod?
Yes.
Up late. It's 9:34 out in Michigan. Thank you for your hard work, Denisa. We're talking all kinds of good stuff about underwriters tonight. We're letting people know that underwriters are good folks. Kyle also wants to know what type of thing home buyers can work on to have the best chance of getting approved. This is a good question. And I think that the way that I would frame it too is what might be the thing that leads the way in reasons why a file might be declined? What's something that borrowers should look out for or work on, in Kyle's words?
So in terms of what I look at, because I'm looking at a file after you have already pulled the credit, you've already looked at the income, you're sending it over to me to verify. I know that when I was writing loans and I was getting a first-time home buyer, the one thing that they really need to do is pull their credit report, have someone look at their credit report before getting too far into it, because sometimes they forget they might have something from 6 years ago that they forgot about, old collection. Sometimes they have no credit, depending on if they just got out of college and never took out a car loan, never took out a car. They make great income, but they don't have that credit established to be able to get a mortgage. On my side, in terms of home buyers, it's sometimes it's the basics that, well, what I think is basic, but if you have your down payment, make sure that it's sourced. You have money in the bank, make sure that if you have $50,000 in the bank 2 weeks before, you just didn't have a random deposit of $45,000 that we need to look for. Every now and then you'll see a deposit and they say, I don't have anything. It was just cash that I kept at home, which Fannie and Freddie do not like that.
Right. Yeah. That's one of those ones where it's like, there's no wiggling out of that bag. Like that's just, that could be a killer. So I like that advice. And it got me kind of thinking, you talked about credit as the consumer facing loan officer. If somebody comes to me and says, I'm looking to buy, but I don't think I'm going to buy until spring of 2022, I encourage them, let's do the pre-approval. I'm happy to take, time, energy, resources from me and my team to look at your stuff now, even if you're not going to buy for 6 months, because like Brett said, there might be a 6-year-old, ding on your credit or something that you need to clear up. Or, like you mentioned as well, somebody's like, yeah, my credit's fine. I've only got this one card that I opened up last month and I've only got $97 in debt on there. Well, if you don't have enough credit lines for long enough and you've got no credit score at all, we got to work on that. You got to open up a secured card. You got to do something so you can get a credit score to populate. So in order to properly coach someone up and help you get to where you want to be, we got to know where you are right now. And a good loan team is going to be able to tell you, okay, everything looks great. If nothing changes between now and when you buy, you're fine. Or we need to get your credit score to populate. We need to clean up this thing on the credit. Worst case scenario, everything might be fine, but you might be at 717. And by getting to 725 or getting to 740, by the time you're ready to buy, you're going to be in the best position to get the best loan. And, with all that time in between, most loan teams can look at it and say, okay, the reason why your credit score is a little bit lower than it could or should be is because you've got a 994 balance on a card with $1,000 limit. Pay that thing down to $200 and you're going to have a credit score increase within the next few months. So anyhow, that was good advice, is to have somebody look at your credit. Yeah. All right.
What else? One other thing I thought of, especially it comes up pretty often with first-time home buyers, but you'll have someone who just graduated from college, let's say December of 2020. They now have been working, we had one recently where the borrower was working at Amazon for about 6 to 9 months. What we're able to do, they're salaried W-2, but you also always need to have a 2-year work history. We can get school transcripts to meet that 2-year work history, so that you don't need 2 years of work at Amazon, but the school will help satisfy that and you can qualify that way as well.
I remember when I was starting in loans too, like I thought I remember learning like it's got to be related to like what you studied. Is that true? Or can it just be, we've got 2 years of college history and now I'm working, in my head, like, Amazon distribution center, and I studied, anthropology. Is that going to work from an underwriting perspective?
Yeah, we don't scrutinize too much with that. We'll use that. We'll be able to look at the transcripts to see that you were in school until when, here was your start date at your job, and then fill that.
Good deal. All right. Will wants to know, what are the most common conditions that processors don't upload?
That they don't sometimes. So when we give, we'll send out an approval letter, and it's not really what they don't upload, but did they upload to what the condition says? Did give us all pages to the asset statement. When, every now and then you'll miss page 5 of 8 because 5 of 8 had that large deposit that we didn't want to see.
Yeah. Well, we don't want to show you that, Brett.
Yeah. So sometimes it's reading the condition. I would say that they don't upload it, but sometimes it's just a communication piece. So that's the good thing. When you get that approval letter on your end, you easily call back and say, hey, what exactly am I looking for here? Sometimes, you wonder, why do I need that letter of explanation? Because that debt was paid off a month ago, things like that. So if you go and then give us assets, you give us too much, now we need to look at that as well. So there's a lot of different things that go into play with the underwriting.
Right. For sure. Kyle's got an interesting question because you mentioned being a loan officer and working as a loan officer. What motivated your transition to underwriting? What kind of crazy person wants to go into underwriting? That's
as I put it. I was in college. I was more engineering based and not so much sales. So I like the makings of the file itself, how you can get from A to B, how you can be that problem solver. So it's a lot more in depth with the AUS, the goals of, you deal with the goals of the buyer itself or borrower, but it's my job to get it to closing. So it's a lot more like a large, almost like if a Sudoku puzzle went from 1 to 100 rather than 1 to 9. There's a lot of things in play that just make it fun to work a file from start to finish.
Yeah. I guess fun is objective. I mean, because bless your heart and bless the analytical engineers' hearts. But, on my team, I've definitely got an implementer, and I'm an innovator, and, Laura's great at the puzzle pieces and great at, doing all the mechanics of the loan. Right. And I just want to talk to people and talk to real estate agents and go out there. But yeah, different passions for different folks. And you like the analytical and engineering piece. So off you go. And I appreciate folks like you, so I don't have to do that stuff.
Great question though.
Yeah. Good question. Jason's got a specific question, which is always good because then there's other folks that are looking to do something similar. When changing my primary residence, how far does my next property have to be to qualify? Where I live, a nicer neighborhood can be as close as 30 minutes away.
Excellent question, Jason. It really depends on, we might get a letter of explanation for a letter of intent. We would look at your current house, the square footage, where it's at compared to the new house, where it's at square footage. And you'd say, okay, clearly he doesn't want a 2-bedroom, 1 bath in this area. He's married, possibly has a few kids. He's going to get this 4-bedroom, 3 bath, and he's going to rent the other one. And then, school districts and things like that, that would be part of your letter of explanation. So there's really not a rule or distance. It kind of goes to that gut feeling of it makes sense, or maybe this is too far from their work in the opposite way. Now it's a 2 hours different. Maybe this is going to be a second home or an investment instead of a primary.
Yeah, I get that quite a lot. And, folks have realized a bunch of equity in the last few years, like, oh, wow, I can take if I sell this house and I bank 150, I can go, put it down and live in the neighborhood I want to live in with the schools that I like. I'll tell a real life story, Jason, too, about new primary. The house I bought in 2006 and lived in until 2017 was backed up to a freeway. And at first, we were first-time home buyers, so we weren't picky, right? It didn't friggin' matter. Me and my wife were just living the dream, and we had a home. But after like 10, 11 years, you realize you can't even hear yourself think in the backyard. So a house happened to go up for sale that was 3 doors down and across the street, same court that I'm in. But it was far enough away from the freeway where you could actually have a conversation in your backyard. I remember still, May of 2017, underwriter saying, like, why are you moving 3 doors down and across the street? Because the house had a pool. It's a slightly bigger lot, but it wasn't that much of an upgrade. And funny story too, Brett. I was working in direct lending at the time, and I sent my loan to that direct lender, and the underwriter actually bounced back the letter of explanation and said, you said that it was because of freeway noise, but you're still by the freeway. Yeah, but I'm 4 doors away and I'm 4 houses down. It's a big difference. It really is. And so, that was a good enough reason was, freeway noise, bigger lot, pool. But yeah, as long as it makes sense, Jason, the underwriter's going to say, okay, that makes sense why you're moving, whether it's 4 doors or 400 miles. If it makes sense and you can write a letter of explanation to justify it, you'll be all right. All right, Zeta. I think this is more of a statement than a question. Just backing up what Brett said about you want to make sure you've got credit and you got a credit score that populates. When her son was buying his house, he was turned down because he had no credit. Not that he had bad credit. They had him get a prepaid card. Credit score populated, got a loan. That's a happy story. Thanks, Lita, for sharing. Here's a good one from Harminder. Do underwriters also decide the interest rate or risk level, which determines the rate eventually for a person? All your friends get a 2.5 and everybody else gets 3 1/4.
So yeah, we don't, we as underwriters, we will assess the risk level in terms of, like we were saying, maybe potential occupancy. That's going to layer risk level. Your goal of a rate and term versus a cash out is a little bit of a risk level. The loan to value as you go higher looked at as a little more of a level. And then just your FICO score overall. On our end, we don't take the interest rate at all. That's going to be based on the program that you and the loan officer go over, and then ultimately decide on what's best for your goals.
Right. Yeah. So they're underwriting the file to say approve and, whether or not it's going to make it to the finish line. But yeah, like Brett said, we're plugging in the system, loan to value, credit score, everything else, and then spitting out a rate sheet and saying, Harminder, do you want 299 or 3.125? And setting up your file on that. All right. Now we got a few different questions, all related to appraisal waivers. If anybody doesn't know what an appraisal waiver is, it's basically the automated system saying, for this purchase or for this refinance, we don't need an appraisal. We've got enough data in the system. 530,000 is what we'll go with. And so Will's question is the first of many that I'm seeing on appraisal waivers. Is there a way to increase your chances of getting an appraisal waiver?
That one can be a little tricky. It depends on if the file has recently been done by Fannie Mae or Freddie Mac in their system. It's all linked to the address overall. There's little things that we can do on our end to try. Sometimes Freddie Mac has a guideline where if you're doing a cash out refinance, you cannot get an appraisal waiver if the loan to value is over 70%. So we've had a couple files recently where our loan to value was in the 72 to 75 range. So on our end, or Denise and my end, we were able to, we changed the appraisal waiver, or we changed the appraisal amount to 70%, was able to get a waiver and then canceled that. On our end, that's really as far as we can go. Sometimes adding in reserves, extra cash on hand will help strengthen the file. But overall, has this file been in Fannie Mae or Freddie Mac's system recently to where they're comfortable with the amount where it's at, more than what an underwriter can really do.
Right. All right, that's good. That's good to know. You know what's funny yeah, that's something that I don't know if I knew that about the 70% rule. So, if nothing else, I learned that tonight. For a cash out refinance, can't go above 70%, but under 70%, because I think we don't get as many waivers on cash outs as we do on the rate and term. And part of it's probably that, loan to value, but 70% or lower is what I got to shoot for. That's good. I know I've seen appraisal waivers on investment properties, but not many. Know thyself first is asking, for investment rate and term, do they qualify for appraisal waiver?
On an investment property, it is possible to get it. You have to have a file where you do not need rental income on that subject property, though. Once that's triggered, you're then going to need a 1007 along with the appraisal, and then you would not be able to get an appraisal waiver probably 99.9% of the time.
Okay. So does it have to be like omitted from the file where you don't have the income in there, or it's not needed to get an approval when we submit it?
Don't need it overall. Yeah, if you have enough just base income from your job and you don't need that rental income to qualify for that investment property, you have a much better chance of trying to get an appraisal waiver.
Okay. See, God, I'm learning so much tonight. See, Brett's schooling me up. I'm going to be a better loan officer at the end of this hour than I was in the beginning. Is there a loan to value? I know for sure I just haven't seen a lot of appraisal waivers on investment properties, probably because I've got clients that are, doing cash out to 75% to, go redeploy that equity, and, they're using the rental income. Is there a loan to value limit too on investment property stuff?
Not necessarily in the guideline, no. It would be based
Okay.
off of the AUS findings.
And then would it be possible to get cash out refi on investment property waiver? Does that matter between rate and term and cash out?
It depends on if the file has been recently done.
Okay.
If you had a cash out on an investment, I can't say it's impossible. Definitely can't use the rental income for that property. But I'm sure I've seen it before where, it was recently done. Maybe within that subject property was refinanced within 6 to 12 months. And there was a appraisal waiver. I actually had a situation before where we did a cash out refinance on a home, had the appraisal waiver. They refinanced 8 months later on a rate and term. We did not have an appraisal waiver. So it's
yeah. Sometimes automated systems and algorithms, no rhyme or reason. Just like some people, are asking me why the credit score is what it is. I'm just the messenger, guys. Know thyself first wants to know how to set up their kids to have a great credit history as they grow up. You want to tackle this one? You want me to attempt it?
Yeah, I mean, I think I would have probably similar to you, but just making sure that they're managing correctly. If you get a couple of credit cards, pay those off as soon as there's a balance. Don't let that linger.
Right. Yeah. I mean, and that's something that people probably underestimate is debt load. I don't know if it's 35% or 40% of your credit score, but it's a big chunk of, if you've got one card with $1,000 limit, another card with a $2,500 limit, and a third card with a $1,500 limit. If you've got $4,862 racked up across those three, and it's $5,000 total limit, that has a humongous impact on your credit score. So, one, for the credit score, and two, to not be paying 16% interest on debt, like Brett said, help coach your children into, financial literacy, where you're not carrying those balances month after month, and it's being paid off, so that you're not, financing a PlayStation 5 over 36 months and paying $1,700 for it. All right. Kyle's got a good one.
Of that.
How do underwriters view borrowers who go through the underwriting process with two lenders at the same time for one property, and he's asking because he's got people asking him like, oh, I want a second backup appraisal in case my first one comes in short. So they're going to go with two lenders and underwrite them. And in this case, it sounds like get two different appraisals too.
Wow. So I guess this comes up fairly regular at United Wholesale Mortgage, just because we deal with brokers specifically. So a borrower usually doesn't know, if you go to a broker, where that's going to get underwritten at. With us being the largest wholesale lender, we do get a lot of those that happen where they just took a loan application with one, and then a week later took another loan application with another lender. They both happen to come to UWM, get into the process, and then we pretty much have to keep an eye on both of them until they get ready for the clear to close to see which one the borrower is going to go with. At the end of the day, at the end of the day, it doesn't really matter to us. Both of them aren't going to close. They really, at the end, we need to get pretty much a letter of intent for which broker that borrower decides to go with.
I've been on the losing end of that before, where somebody called me and said, hey, Matt, you know that file you've got? Another broker has that file with us as well. And I can't remember what exactly it was, but I think I ended up telling my account executive, it sounds like they started with the other broker, they locked with the other broker, and basically, conceded. As long as the borrower's taken care of, I know they're in good hands at United Wholesale Mortgage. So let it be. But yeah, it's probably, an awkward position for some lenders to be in, where you're
double.
That
one was a pretty that one's pretty lofty. I mean, I don't know if it was a refinance or a purchase, but but either way, if you're paying for two different appraisals, you're looking at probably what, $500 to $700 a piece. Hoping that one of them comes in higher.
Right, not getting any cheaper either. I don't know how versed you are at YouTube, but this green right here means super chat. So basically, we got a tip. So you are crushing it so hard that people feel the need to throw money at us. Thank you, Jason Hibbert. Appreciate it. I know that my 8 and 12-year-old boys, when I get to go home and tell them that I got super chat on YouTube, I get some clout in the house, as the small micro YouTuber that I am. So thank you, Jason, for that, for allowing me to have some clout with my boys. Appreciate you guys. Under the impression underwriters instantly disqualify you. I understand now topics within reason can be discussed. Yeah, for sure. And I mean, you're going to deal with a loan officer who every loan office, well, I shouldn't say every, most loan officers work on commission, where we had an initial discussion. We paid to pull a credit report. We took your application. We got staff working on the file. Like, we've done all this work. If we don't close the loan and get paid by the lender, because that's how loan officers get paid, is the lender pays us once it's closed. It's not something that consumer gets billed, $2,700 at the end. Then we want to close your loan. And then we've talked about here with Brett, he's on our team too. So unless there's something that we can't massage or a reason why we can't get this thing to qualify, we're on your side, and we definitely want to discuss ways to get your loan approved. I mean, I feel like I deal with it probably every month. We've got 30, 40, 50 loans in process at all times. There's going to be ones where, based on 2020, I had one where I've got a firefighter who's got variable pay. We couldn't use as much income as we anticipated. And so it's a real quick, okay, talk to the underwriter. If we pay off this $2,700 debt, now our, debt to income ratio is back with, in the parameters where it's going to get an approve eligible in the system. We're good to go. Right. And so, it's not just our DTI back end is 45.6. You're dead, disqualified. See you later. Have a nice day. Like, we're trying to work things out. I promise you, Jason. And we're going to do all we can to get that thing to the finish line. All right. Campbell C has a question. I know I want to respect your time and I know it's 10 o'clock where you're at. So let me know, Brett, at any time where you got to jump off. What was your game plan for tonight? Are you good for
I'm
another
having
15
fun.
minutes?
Questions are coming.
All right. All right. Cool. We're in it
Absolutely.
to win it. Yeah. Sometimes people are like, man, Matt, you spend hours every single Monday. Yes, it's fun. And we saw tonight, I'm getting better. Brett's schooling me up. I'm learning about how to get more appraisal waivers, better serve consumers. So it's going to be a win for everybody. Campbell wants to know if you start with an unconventional loan, and I'm picking up what you're laying down, Campbell. You're saying something other than a conventional loan, so it's FHA or something else at a higher interest rate. Can you or maybe unconventional? You're talking about a non-QM loan. It might be a hard money loan, might be a bank statement loan or a debt service coverage ratio loan. Can you refinance into a lower interest rate with a conventional loan in 1 to 2 years when your credit gets better? Go ahead and take this one, Brett. This is a good one. And then tell them to call me.
Absolutely can. It really depends on everyone's credit profile a little bit different. We have one in process right now where they're looking to buy a home, but there's a current jumbo that the borrower has. Their current loan is at 8.4% that they took out 4 months ago, and they're now they're doing a refinance to get that down to, I believe it's 299, so in that realm. So it really is, you have a loan, you're not stuck at you can take it out 6 months later. You go, okay, cool, I'm good to go. I can finance it now, do that rate and term, and save some money.
Right. Yeah. And that's like, sometimes that's the game plan too. And that's something that you work up with a loan officer where it's, I don't currently qualify because I've only got 1 year self-employed and I need 2. So I'm going to use an alternative loan product, maybe a non-QM loan that's based on the debt service or the rents. And so I can get you that loan that's 5%. Once you file your 2021 taxes and you've got 2 years self-employed and we've got a good average over those 2 years, come 2022, you filed your taxes, we've got those, we're going to refinance you into a conventional loan at a lower interest rate and get you on your way. So that's the good news, is you're always going to be able to, if you qualify, and if, between credit and income and all the other factors that go into qualifying for a conventional loan, if you qualify, more than happy to. And then what you do is you go to greatmortgagebroker.com. I'm usually not such a salesperson, but it just feels right sometimes to just say, go to greatmortgagebroker.com, quick 6 questions, where you're at, what you're looking to do, and we'll take good care of you. Man, that was just a nice, smooth layup intro to that. Yeah.
Like water.
This is a good question from Theo. Do underwriters consider waiving inspections as a negative when approving loans? This is a good question that I honestly have never even thought about. I don't know. If you have a file, Brett, and you're looking at the contract and it says that the buyer waived inspections, is that going to matter to you?
On our end, we wouldn't be worried about it. We're going to get the appraisal in most of the time, assuming it's a purchase. So we're going to get that appraisal and just double check the photos. The appraiser is going to take a look to see if anything might be subject to repair. But then even sometimes you'll get an appraisal that the appraiser says it is as is. But then as we're doing our review, we might see a water shot on the ceiling. So we want to make sure that any potential water damage has been fixed. We might see a crack in the outside stucco. You might see something, maybe some wood rot down towards a floorboard. So we don't worry about inspections so much, but we will look into the appraisals and double check those photos mostly as we can.
Yeah, I had one of those where some appraisal photos showed some cracked foundation. Underwriters, no likey. All right, flash of lights got a underwriting question. If a home buyer needs to raise more funds for closing costs, can he get a loan credit card advance if there's room in the DTI, or sell their only car with a 2-hour commute?
This has been attempted. So anytime you're looking for funds to buy a new house, you can get a loan, but it must be a secured loan. So if I own my house now and I decide to take out a home equity line and use those funds for a down payment on a new house, I do that. If I want to do a cash advance on a credit card, though, that's not secured, so you would not be able to use those funds towards that new purchase. In terms of the car, that happens well. Anytime you're going to sell a car within a couple months of your loan application, you would need to prove that you own another car free and clear. That's usually what we look for.
Yeah, we want you to be able to get to work so you can pay your mortgage. How old do my kids need to be to get their own mortgage? That's another good question.
I think you'd just be looking for 18 with appropriate income and credit.
Yeah, I mean, 18-year-olds are Dogecoin millionaires nowadays. So
yeah, you got to be an adult to sign into a contract. So
18 years old. Yeah, that would be a good start, buying your first piece of real estate that young. All right. Lindsay Morgan. If I took unpaid time off work that occurred between pay periods where 2 paychecks were affected with lower pay, will the underwriter look at that negatively for 30 days of pay stubs?
Excellent. Yes, it comes up pretty. It can depend on why you took time off. Going back to earlier when we say that we have like our verbal verification team call the employer, sometimes they will verify that someone might be on leave. So then we will look into that a little more, look at that risk level. Depends on what pay stubs have. We're only going to look at 14 days of pay stubs. So at the end of the day, it depends on what you give the broker, what the broker submits to us. We're going to look at the pay stubs and how much was earned. So in this case, if you had some time off, we're going to ask for more pay stubs, or we might look at potential variable income to where it fluctuates. But we're also going to look at the overall year to date that you've earned as well to see if that lines up with what your 40-hour-a-week pay would be. There's a lot of different variables that go into it when there's some unpaid time off on a pay stub.
Right. Yeah. And then it's going to be just the average, the dreaded average, which I get a lot from borrowers where they're just like, no. I make, this much per hour times this many hours. But then, when some weeks you have 32 hours and some weeks you got 40, and then one week it's 24, unfortunately for borrowers and for me as an originator and Brett as an underwriter, we've got to take an average. It's the only way, to really predict what you're going to get in the future is to average what you made in the past. So, when there's unpaid time off, reduction in hours, anything like that, then it's going to pull that average down. That sounds right? Right. Yeah. See, I could be an underwriter.
Each situation is different.
I'd have to change my name from Math Mortgage Guy to Math the Underwriter, but I could probably do it. I could pull it off. All right. Sophie has got a question, and she's calling us experts, so we better deliver here. We're planning to move from our house eventually to a smaller one as our kid is going to university. We found a smaller house 30 minutes away and wanted to buy it as a primary, but the lender says it should be only investment. Please advise how we can act on that. That's a good question. So essentially she's trying to downsize. So how would you look at that if I submit that loan and I say, Sophie is trying to downsize because the kids are taking off to university and her husband don't need as much room?
That's a good one as well. It's kind of similar to the situation we had maybe half an hour ago. But I want a house. It's 30 minutes away. It's a better location. In this case, we underwriters, we would be looking for letter of intent, depending on looking at your age, how many dependents you have showing. Okay, they are college aged, and then looking at the location, but overall, if you're downsizing, that's a common reason to look for a smaller house.
Right. Yeah. I mean, I think it comes down to a lot of times too, where I tell people, like, if it makes sense, it makes sense. It's not that hard, like Brett said, to look at it and go, okay, you've got dependents, but they're 18 and 20, it's plausible that they're going off to college. You try to say, hey, we're downsizing. You've got a 14-year-old and 11-year-old. And, your letter of explanation says that they're going to live with grandma or something. I don't know. I don't know if that one flies. Maybe it does.
It could.
Right,
and
Jason,
then it depends if you're going to,
go ahead.
If you're going to rent primary, or you have a lease for it. So those are all different things that play into the overall assessment.
Right. All right. Is it acceptable to refinance your student loan for a better rate while you're applying for a mortgage?
Yes, Jason. So you can. It will lead to those documents. Matt on his end is going to then need to get those documents from you as that in process to be able to qualify you at lower payment if you need that to qualify for the mortgage.
I'm picking through some of these to see the best questions. We got some self-employed ones coming, which I think, like, self-employed it's always been a hot topic because I, as somebody who's independent broker and self-employed in many respects, like, I feel for self-employed borrowers. Like, I'm out on my own, I'm doing my own thing, and it's 5 times harder to get a loan. So, let's see. I'll go in no particular order.
We probably need.
What were we going to say?
Oh, we do an entire show on self-employment.
Oh, for sure. I know when I made a video on self-employed borrowers, I got more comments than any other video. And so this is a good question in regards to self-employed income. What lines you use to calculate income for self-employed borrowers on the tax return?
Oh, great question. So that is it depends on how you file. So whether you just a regular Schedule C, 1120S, partnership, C Corp, usually we're looking at the overall income, looking at the depreciation. I believe, everyone would have access. You hop onto Fannie or Freddie Mac's websites, or even in terms of Matt's approval, when Matt goes and pre-approves you, he would plug everything in, say, okay, here's from your tax returns, this is what you'd qualify with. In our world right now, that's what your tax return would tell you that you qualify with, but then we need the year-to-date profit and loss with the assets to sort it. But there's income worksheets that Matt can look at to say what income we use with the calculation. Right.
Yeah, and I think that we try to be super transparent with borrowers, and some self-employed borrowers have a really good grip on here's exactly what my self-employed income looks like, and others are just like, I run my business, I do good, I ship that off to an accountant, and I don't know what my bottom line is. But whatever the case, when you go through the pre-approval process, we can show you, and we'll share with you the Excel spreadsheet that says, here's what your Schedule C says as far as income, what we have to subtract, what we can add back, and what the final number is, what that looked like in 2019, what it looked like in 2020, what the average looks like. And then, like Brett said, we're going to want the year-to-date profit and loss, mainly to show that you're still trending up, or you're still, operating at least the same level that you were the year prior. Because for lenders, whether it's self-employed income or W-2 income, they're the thing that they want to avoid is 80,000 last year and you're on pace to make 50 this year. That's usually a red flag. And as you would imagine, it makes sense, right? Like if somebody's making 40% less than last year and you're lending them money, you want to know why it's trending down, and hopefully, it's not, the beginnings of a decline where you're not going to be able to pay back the mortgage. This is interesting question. I don't know if I understand it. Just purchase a primary residence. How long before I can refinance into an investment loan? So I don't know. I guess maybe we'd want some follow-up, Rob, on why you're wanting to refinance it into an investment loan, and if I don't know, I'm just kind of guessing here, Brett, but maybe they're thinking about buying a different primary, and so they're going to refinance this into an investment loan. Maybe I'll ask my own question in place of this one, because I've had this come up quite a bit, is where somebody buys a primary and then 3 months later, they're like, oh, no, I want to live there. I've actually heard some cases where a lender has said, well, you just bought this primary, so this one's an investment now. Like they're going to make them refinance this one as an investment before they buy the new one. I just saw Rob's follow up, and I apologize, Rob, for laughing, but welcome to being married. He got married and his wife doesn't like the house he bought. You got to move. And you're right, Rob. You got like happy wife, happy life. So you better, I guess in this case too, like we'll frame the question like that, Brett. If 2 months later, 3 months later after buying the primary, he wants to buy a new primary, can he submit a loan to refinance this investment and then go buy a new primary?
Overall, it is going to depend on the time frame of when it was bought. If you're probably within 3 to 6 months or 6 months over, you can usually use that change of life circumstance. And then it really depends on if you need the rental on that current primary to qualify for the purchase. So a couple different moving parts there for your overall qualification.
Right. Yeah. I mean, that's what I, try to stress to people too, is like stuff happens, right? Like you move to a neighborhood and, you realize it's not the school you want to send your kids to, or you get married and the wife, in this case, Rob, wants to move to another neighborhood. Even if it's 4 months, 5 months after you bought that as a primary, you might be able to, because it's a legitimate reason and there's a life-changing circumstance, just write the letter of explanation and say, my wife, refuses to live in this house in this neighborhood. Now we're going to buy over there. And that might do it, right? You might not have to refinance into an investment property. Now the questions are piling in. I gotta pick the best ones. Oh, this is a good one, because this has been something that's been fairly common for me in 2020 and 2021, as people have seen humongous, equity position increases as their home prices increase. Can you refinance, get cash out, and get pre-approved for that investment property that you're buying at the same time? I'll let you answer that and plug me again, Brett.
Absolutely. This is pretty common. If they close simultaneously, it really makes it easier, because then we don't need to source the funds from the cash out, then use to purchase the investment. If you need those funds to close, you would then, if you don't want to do it simultaneously, you would take a cash out on your primary, close that, deposit those funds, and then you can purchase the investment. We'll have your closing disclosure. We'll have your assets that have those funds sourced, and then qualify it that way as well.
Yeah, and that's what I usually tell people too is let's do it concurrently. The lender doesn't have any problem with it, especially if they're doing both loans. They see cash out refinance, what the new payment's going to be, and they take that into account when they're qualifying the other purchase. Um, and doing them concurrently, it solves a couple things. One, you don't have to provide another 30 days pay stubs and all these updated documents. It's all in one. And two, for a lot of investors I work with, cash out refinance to buy a property forward, stick money in the bank, and then wait 6 months, 8 months, 9 months, 10 months until you buy for like that investment property. You're paying interest on that money versus, kind of taking it out when needed, which is a really common question I get. Like, do I do a home equity line of credit or do I do a cash out refinance? The pro, when you're weighing pros and cons on home equity line of credit versus cash out refinance, is like you're only paying interest once you draw on the HELOC. And with a cash out refinance, once you pull it, interest starts day one on that cash out that you took. So very good question.
Yes. One thing that we don't like to see is if someone does a cash out on a primary and then 2 months later goes to purchase another primary. That is usually a red flag. We would make you refinance that first loan as an investment so that then we can purchase the primary, because often they'll want to use rental income on that first departing primary.
Yeah. Yeah. And that's one too, where I think in one of my loan officer groups, I saw that where somebody's like, oh shoot, like we just got conditioned where we got to refinance this one that we're leaving as an investment property. It's like, yeah, you just did a cash out refinance 48 days ago. You can't go, buy a new primary with those funds.
Yeah.
So yeah, be careful of doing some of that stuff. Consult a loan officer is going to give you good, straightforward advice. Not a yes man. It looks like Alexis and Johnny might be the same team because they have the same question. Maybe it's husband and wife, boyfriend and girlfriend, and they want to know. This is a question that probably is a good real estate agent question, but I'll try to answer it anyway. Is it better to offer 1.1 million and waive the appraisal, or offer 1.125 and keep the appraisal? What is a stronger offer? Only have 275,000 for down payment. For me, being in California, like this is a scenario that I've seen come up a lot, where one, there's a fear of the appraisal coming in light, and there's only a certain amount of down payment funds available. So I think what comes to mind first for me, Alexis, is you want to have a game plan for yourself before you think about like what offers are going to be accepted. Like, one, do you qualify if you waive an appraisal contingency and the appraisal comes in at $1 million, and you've got to put 10% down and bridge that $100,000 gap? Because there are products, shout out to United Wholesale Mortgage, 10% down jumbo, where you can put less than 20% down. So, for this specific price point, I had this come up a lot in the last year where, we looked at it and we said, in order to get this thing accepted, it's listed at 975, but you got to offer 1.1 and you got to waive your appraisal contingency. It might only appraise for $1 million. If it does, and you have 275,000, like you said, you don't have enough for 20% down plus reserves, plus closing costs, plus the $100,000 gap, like all that stuff. So if we were to have to restructure it and do 10% down plus the appraisal gap because it appraised at $1 million and it, is in contract at 1.1, like, can you do that? I think that's the most important piece. And then you can talk to your agent, who's going to hopefully talk to the listing agent and say, hey, listing agent, would you rather have the comfort of a $1.1 million offer where there's no appraisal contingency and it doesn't matter, or 1.125? As the buyer, I'm going to tell you you're safer at 1.125 with an appraisal contingency, because then it comes in at $1 million you can renegotiate. But, what's safer and better for you and what's going to get accepted in the market are two different things. So that's a really, multi-layered question, which I would defer to the agent and, probably try to come up with a game plan. But more often than not, a lot of things in real estate, it's going to be based on what's important to the seller, right? And it's like one home to the next. Something that matters to seller A doesn't matter to seller B. Seller A wants to close in 17 days. That's the most important thing. They'll accept less as long as they know it can close in 17 days. Another seller can't close that soon. They want it to be 30 days. They need 21 days and free rent back. They need, other things that might not be that. So that was long-winded. Sorry for taking us off track, but that's my best chance at playing a real estate agent besides me giving advice to $1 million listing on TV. This is a good question. I'd love for you to clear this up for folks here. Do I have the best chances of approval if I apply as an individual versus an LLC?
Let's see. It just depends on your income. Now, he's not talking about purchasing the home in an LLC, is he?
I think that might have been it, where it's like, lender wants you to close a deal in your personal name. Conventional lenders aren't lending to corporations. And so if I apply as an individual versus
businesses.
Right. Yeah. And so your best chance of approval and your only chance of approval, G Banga, is as an individual. There's, portfolio lenders and other lenders that might lend to LLC, but they're going to charge you higher interest rate, more costs, and all that other stuff. And so I get that question quite a bit because I got investors that like, oh yeah, we've got an LLC set up and we're 50-50 and we want to buy this. And, conventional lenders aren't lending to corporations. They're lending to people and they're basing the, in residential financing as opposed to commercial. It's, the person's credit qualifications and income that's being underwritten. When you get into buying apartment complexes and commercial stuff, then it's like looking at the building and how that thing performs. But we need your personal stuff. Let's see. Let's grab a couple more questions. We're coming up on an hour and a half. My family probably misses me. It's past your bedtime, Brett. So I appreciate you hanging out with us for an hour and a half. I'm gonna grab a couple more and then I'll let you go. What time do you get in the office in the morning?
About 8:30.
Oh, okay. All right. You're good. You won't be sleep deprived.
We're all right.
I'll give Matt a call. Yeah. Let him know that had you answering questions. There's some questions here for me, but I'm going to get the underwriting questions because those are the ones that Brett, the expert, is here to answer. Can you gross up pension income?
The question cannot gross up pension income. I'll just be looking at grossing up Social Security.
All right. The answer is no, Scott. I'm looking for a strong fixed flips oriented realtor in Atlanta that have great communication skills as in today's. All right. I don't think that was intended for either one of us. I'm definitely not doing any fix and flips in Atlanta, but best of luck on your realtor search there. What's funny is I answer this question. This is, as you can imagine, for a loan officer, a very common question. You're in underwriting, so you're doing stuff, in that realm, and you're no longer a loan officer. But I'd love to get your take, just because it's not necessarily your wheelhouse. I've answered this question 1,000 times. What are your predictions, Brett? And you're going to be like me, where everybody's got a prediction. Somebody's got to be right for 2022 interest rates.
Ooh, it's hard to tell. It's a commodity, just like anything else. It's like when I fuel my car. dang thing takes premium, and sometimes it's 390, sometimes it's 420. It's really hard to say with the inflation, but we're still dealing with some of the COVID issues. So I think it's hard to say that the economy is strong, which would help keep rates lower, hopefully. But then with the inflation side, property values continue to increase. I would imagine they're not going to be rock bottom like they've been the last 12 to 18 months.
Yeah.
I don't think
I mean,
we'll
I think that I think that it will be a slow increase, and my prediction has kind of remained 3.5 to 3.7 ish in 2022. Whether we get to 3.5 by January or it takes until March or April to get to 3.5%, like we'll get there. They're trending up. They're trending up very slow. Like Brett said, we don't have a super strong economy where we're going to be able to, handle the blow that we would take if rates went to 4.25 2 weeks from now. So, for consumers, I think my best advice, and I literally recorded a video on this today, like home prices are more than likely increasing in 2022, whether the, Mortgage Bankers Association or Fannie or Freddie or Zillow or anybody, if they vary from 4% to 6% to 8% to 16% home price appreciation, wherever it lands, if it's positive home price appreciation and everybody who predicts interest rates predict higher and it's 3.5, like it's cheaper to buy a house today and next month than it's going to be next July. And so if you're in a position to buy, I looked at some notes today from some clients that said, we're holding off for now. Home prices are high. And I was wondering, like, what are they holding off for? But that's another show. And that's another conversation. This is going to be the last question. Then I'm gonna let Brett get out of here. I appreciate the heck out of you staying on, Brett. This is something that's changed over the years. How many loans should you have with the same bank or broker?
So we're talking mortgage?
Yeah, and so I think that like maybe people do or don't know, like the limit with Fannie and Freddie is 10. But this is like how many should you have?
Okay.
And like how many should they have with UWM, or how many should they have with Matt? Should I spread them out? Should I have some with Mike the mortgage guy and some with Matt the mortgage guy? I mean, I can even answer this too. For me personally, it's a lot easier when you go to loan administration, like UWMloanadministration.com, and like you're paying all your mortgages in the same place and you set them up on auto pay. But I think for a small time, actually, UWM said we're only going to do 4 per borrower. And that was a COVID thing for sure that got lifted, where now like they'll allow you to do 10, up to 10 again.
You can have a max of 10 financed properties.
Right. And UWM will take them all. I know that some banks might have overlays where they're still maxed at 4 and they're telling you they don't want any more than 4. I mean, shoot, there's some banks that won't even do investment properties, but for the good guys, for UWM and the quality lenders that I'm sending business to, they'll allow you to do all 10 of their, Fannie Freddie stuff with them. And yeah, so I thoroughly enjoyed this, Brett. Hopefully, you had some fun here with the YouTube live community. Thanks for everybody who joined. Every Monday at 6 p.m. Pacific Standard Time, I'm going live. I'm going to try to get more guests like Brett. I think people are they're kind of tired of just seeing me on here by myself every Monday. So grabbing an underwriter, getting some account executives, getting some people on here that we mix it up a little bit. Definitely is cool thing to have on here. So thanks again, Brett. I appreciate you, man. Any parting words for the people?
This is great. Thanks for having me. If you leave comments, let Matt know. If you have further questions, we can always do this again.
Yeah, for sure. We can circle back. Let me know what you guys thought of it. Yeah, leave comments with any follow-up questions if we didn't get to them. If you're watching this on replay, Hopefully there's some good stuff in there, and then you'll have to leave comments and questions for the next time we connect. Thanks, guys.